Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this out as big tech struggles to impress. A blowout quarter for Nvidia, failing to spark a market rally. Emily Roland of John Hancock Investment Management writes in the following: "It's amazing the market doesn't seem to care. It's like Nvidia is winning the game, but investors are giving participation prizes out to all the other players." Emily joins us now for more. Emily, welcome. I think a lot of people feel the same way this morning, looking at those numbers yesterday evening, looking at the price action this morning, and Emily asking themselves the question, what is going on?
Yeah, John, there has never been anything like this in U.S. corporate history. 80% year-over-year earnings growth. The estimate was 57% on a $5 trillion company. Like, this is just so remarkable. And then you wake up this morning and you look at the relative winners again, and it's the Kospi, it's, Europe, it's the CAC, it's everything else except U.S. technology companies. The market cap of Nvidia hasn't really changed very much over the past 6 months. And meanwhile, we've just seen massive multiple expansion, massive changes in terms of the size of pretty much every other company on the planet. We've been talking about this sort of idea of March madness coming up. To us, it's momentum madness that we're watching. And you think about the brackets, it's Spain, it's the Kospi, it's Europe, it's silver. And that's really where the focus has been. And the markets are really not all that impressed by Nvidia. Pretty remarkable to us, given the strength of the earnings, the margins, the revenues there.
Emily, you saw it as soon as the year started, straight out of the gate. The Kospi off to the races. South Korean equities are up by close to 50% year to date. We're not even 2 full months into the year. You talk about the momentum. The team's going to have plenty of questions about tech and what's happening stateside, but the momentum that's happening elsewhere, do you really want to fight that right now?
I mean, momentum, as we know, is a really powerful force. Matt Miskin and I have been watching the Kospi for about a year now. It's up 160% over a one-year basis. And we're always trying to square that with what the fundamentals look like and what the economic picture looks like in some of these countries. You look, for example, at Europe. The estimate for earnings growth this quarter was 3%. They barely beat that. And then European equities are on fire. In the United States, the earnings growth estimate for this quarter was 8%, and we're coming in at 15%. That's almost double. Technology companies just produced 33% year-over-year earnings growth. In the United States, it's not getting rewarded. Look at Japan. Their stock market's on fire. Guess what their GDP growth is? It's 0. They just missed a technical recession. So it's just hard to really square this momentum, this sentiment, this technicals that are driving these markets with what's really happening underneath the surface. We want to participate in this, but investors might want to think about right-sizing positions in a market that's been driven by momentum.
At the same time, Emily, U.S. markets have already benefited from momentum, right? I mean, if you look at Nvidia shares, they've gone from $3 essentially at the beginning of 2019 to almost $200 today. I mean, it's been a tremendous blowout in terms of market capitalization. How can you understand, even when we're talking about such big numbers, what that's baking in and how many more multiples to price in at a time where there are many beneficiaries, clearly, and the race is very, very intense?
Yeah, absolutely. And the earnings engine is on in the United States. So when we think about valuations, we really care a lot more about the denominator. And we've seen that, especially in some of these AI beneficiaries. But we just saw so much momentum. To your point, last year, it's just going to be hard to repeat that, to continue to compound that. So we understand this idea that there's catch-up potential in other areas of the market, but we are always following earnings. We believe that stock prices follow profits over time. And that's where the earnings are. Now, do you need to protect against the valuation risk that's inherent in some of these big, large cap companies, tech companies in the United States? Absolutely. So what we're doing is we're looking at sort of our favorite, more quality cyclical areas of the market. Industrials has been a top idea for us for quite some time. We're going down in market cap and looking at mid-cap stocks, which have elevated earnings growth prospects and at least like reasonable valuations in a world where everything is expensive right now. So it's about owning tech. It's about looking for the earnings, following the profits, but then diversifying from that down in market cap and looking for quality value.
Emily, is it a contradiction to go down in market cap, to go to smaller, riskier companies and also like high quality bonds? I mean, is there a contradiction here betting on the reacceleration of the economy on one hand, but then on sort of the opposite on the other?
So great question. So it's a key reason that we're overweight mid versus small cap stocks. We look at small caps, they're lower quality. 40% of the Russell 2000 index is comprised of unprofitable companies. We really prefer to be up in cap to mid caps, which are not our parents' mid cap stocks anymore. These are pretty large companies. But on the fixed income side, that's an area that we just think is mispriced. With the 10-year Treasury yield still over 4%, there's opportunity, especially in the intermediate part of the curve here, to lean into that. Bonds returned 4 to 5%, or 7 to 8%, like very quietly last year. We think that can happen again. Now, there's not as much value on the shorter end of the curve now. Given the moves there, investors can benefit from roll down. They can get income. We don't think that bond investors are sniffing out the disinflation and the lower growth that's coming down the pipeline. And that's an area that we think offers some relative value across markets.
Emily, if investors like utilities, materials, and some of these more tangible assets, aren't they also part of the AI trade? You have to have a case that the AI build out is going to be real.
Oh, that's a huge part of it. These are traditionally more defensive assets, but they're also benefiting from the build out of data centers around AI. We're looking at industrial production, automation, robotics as key themes. So these sort of old school, parts of the economy, parts of the market are also, benefiting from this AI build out, the lack of supply that's needed in order to build the infrastructure here. So, we're looking at that as an opportunity. Again, to sort of look at the tertiary beneficiaries of AI here.
So wouldn't the market view that as the AI trade is real? And when you see blockbuster results like you have from Nvidia overnight, that you want to buy into it even more this morning?
Yeah, absolutely. And I think, Anne-Marie, the challenge is just the size of this. You look at how important that market has become to the economy, and it's just remarkable. Consumer net worth right now is sitting at a record $176 trillion. The stock market at $60 trillion dwarfs the size of the U.S. economy right now. So we've seen this incredible capital appreciation that's been driven by AI as being the most important thing. The market is like the tail that's wagging the dog of the economy, and it's usually the opposite. So we want to think about diversification given the fact that there's so much wealth that's concentrated in AI, and it puts us in a little bit of a precarious position. If we do see a challenge here, there's a lot that's been written, of course, as of late around software companies and the obsolescence potentially there. We think that is overdone, but we've got to think about how much of a risk there is given this massive wealth concentration in the AI trade, and think about other ways, other assets to own to diversify from that, whether it's infrastructure, whether it's bonds, whether it's utilities, et cetera.
Stay with us. More Bloomberg surveillance coming up after this. Nvidia in the pre-market high by 0.9%. The view on Wall Street looks like this. Angelo, Zino of CFRA with a 26 price target of 250 right in the following. Nvidia posted Jan Q revenue of $68 billion, crushing expectations, driven by continued AI infrastructure build-out and successful Blackwell platform ramp. Angelo joins us now for more. Angelo, on this name, one sell, 4 holds, 78 buys. You're one of them, a strong buy, and a rally has stalled. What's behind it, Angelo?
Yeah, John, I think it has everything to do with it's something we had written about back in December. It's this changing AI narrative that you're seeing across the markets, right? And I think right now the street really more focused about the risks tied to AI more so than the growth opportunities here long term from AI. And I think the street's really trying to grasp the two sides, but right now they're really focused on this the risks tied to the AI side. You're getting this massive AI infrastructure build out, but we have yet to really see that AI monetization story really play out to the extent that maybe others had hoped it would play out to this. At this point in time, it's going to take time in terms of this AI monetization story. And I think there might be others out there that are just taking this wait and see approach. So we're getting these beat and raises. The quarter really didn't tell us anything new in many respects, in the sense that we expected a beat and raise, in the sense that we just had a Q4 earnings season where these hyperscalers all significantly ramped up their CapEx spend. So 26 is going to be good. I think that's pretty much baked in the stock. 2027, I think at this point also the visibility looks pretty good as well. I think the street more focused about really that AI monetization story at this point in time.
To put simply what you just said, Angelo, is it a case of fear porn trumping any kind of fundamental performance? Because ultimately, I don't know where the risk factor was in the earnings that were reported by Nvidia.
Yeah, I mean, I think when you look at here, I think you're right. I mean, you look at Nvidia, and I don't think you're going to necessarily see, anything that's going to cause you to raise an eyebrow, be concerned about the story here this quarter, next quarter, the quarter thereafter. I think, again, it is about just monitoring the markets at this point in time. I think on the software side of things, there's definitely some concern. You look at what Ben, and you guys just really talked about Salesforce, but you look at Benioff, what he had to say about Salesforce, his conviction level there. You look at what OpenAI and Anthropic are doing. We need to monitor all of that. We need to see this agentic AI inflection really start to pick up in the second half of this year and into 2027. I think if you see that, you see those new use cases emerge, I think then Nvidia also starts to work alongside that.
One thing that Salesforce did seem to point to is Agent Force, this idea of actually using agents, AI agents, to try to monetize this. Exactly what you're saying, that NVIDIA needs to see, and frankly what Jensen Huang was talking about, that he is seeing that inflection point where you are seeing a monetization. What will it take to prove to Wall Street, to analysts, that the monetization is taking place? And ultimately, this is kind of the stick in the whole story. Is it vast layoffs to justify the expense? Is it efficiencies that get borne out in other ways that could potentially be punitive to the overall economy?
I mean, you need to see it in the numbers from the hyperscalers. You need to see it in the numbers from, and you have seen it to an extent from the hyperscalers, right? You've seen them be able to monetize AI to an extent, maybe not to the degree that Wall Street has wanted them to. But when you look at the AI inflection thus far, it really has been dominated on the consumer side. And really, you really can't monetize the consumer at this point in time because they're getting this stuff for free. On the enterprise side of things, that's where you need to see those applications really start to pick up. You need to see a number. You don't need to see the entire SaaS community really start to benefit from it, but you need to see some big wins there. You need to see that inflection in the second half of this year in terms of revenue acceleration, something that Benioff had talked about last night. So you need to see some of those use cases really start to pick up. In terms of the token count, the increase in tokens, that's going to play out. But again, we need to see the revenue really tied to that and be demonstrated, for Wall Street to really like the story here and to warm up to AI again.
Angelo, on China, it's the largest market for chips. Do you think at any point this year, Nvidia will be able to make some revenue from Beijing?
I mean, listen, personally, I'm starting to lose hope on the China story, right? I mean, it's hard to really, continue to pound the table on China just on the fact that you've got these geopolitical uncertainties out there. The hope would have been at this point in time, we'd start to see at least some sort of incremental revenue tied to China. Given that we haven't seen it yet, I'm just on the sidelines and saying, hey, listen, if we see it, great. If not, at least Nvidia continues to find ways, to see their revenue trajectory continue to increase. But if you're Jensen, you continue to want to, and to some extent need China participation more because of the developer community there, and for those developers to really build on China's software ecosystem. But up until this point, and we've seen it also from AMD. AMD did see about $390 million or so in terms of China revenue in Q4. They guided to only about $100 million here in Q1, and the biggest reason for that is they just don't see the visibility either, and there's a lot of uncertainty. So at this point in time, we're not looking for much out of China.
I'm glad you brought up AMD, though. They are making some money off of China. What's the difference between what they're doing versus Jensen Huang?
It's hard to say. I mean, at this point in time, it's really just about the type of licenses they're getting approved for. I mean, clearly AMD is a much smaller scale type company relative to Nvidia, but at this point in time, it's all about getting the necessary licenses approved there.
Stay with us. More Bloomberg surveillance coming up after this. Andrew Bishop of Signum Global writing, President Trump is not eager to go to war with Iran. This means that if in doubt about whether diplomacy can still succeed, he will continue to give it a chance. Andrew joins us now for more. Andrew, welcome to the program. The US has already demonstrated superior military capability, and the Iranian government has already demonstrated how stubborn they're willing to be. Where is there space for a diplomatic breakthrough?
So frankly, in terms of getting to an actual agreement, I think there's very little space. We've been optimistic. I don't know if optimistic is the right term, but ever since January 14, that fateful day when it looked like President Trump was going to strike, ever since that day and on that day, we've continuously said that the president was not going to strike for several months. And that continues to be our view, not because we're optimistic about, as you say, the substance of these talks, but because we think the president wants to drag them out for as long as possible, both to see if there's even the sliverest of possibility of getting a breakthrough, but also for calendar reasons. We're in the middle of Ramadan. You've got Nowruz, Persian New Year. Liberating the Iranian people by bombing them is not necessarily good PR. And then President Trump is going to China at the end of March. And we all know that this would potentially be a multi-week operation. I don't see how bombing one of China's biggest suppliers of oil right before visiting Xi Jinping is going to help extend the trade truce.
So when do you think this could start if Trump had to use this option of a strike?
Yeah, we've said since January 13 that the most likely is after April 4, so essentially after he returns from China.
But then that would be going into the summer, which is peak driving season here in the United States. Andrew, how does the president weigh potentially what a spike in oil would be? Tyler was talking about the Iranians being willing to close the Strait of Hormuz to gas prices in the United States ahead of a midterm election.
Yep. That goes exactly back to both why we think he's so reluctant overall. And then on your question about timing, that gets to the issue of the fact that the Iranians are so hard-headed. I guess my point, and I do mean the government in this instance, what I mean by that is I think the president would like to get a deal before April. But if we don't get a deal, then he will act. I mean, what you see is what you get in terms of this government's position on striking. They want a diplomatic deal. If they really can't get one after having tried and tried and tried, they will bomb.
At the same time, Andrew, you could look at the troop buildup in Iran and around Iran, and you could look at the fact that a lot of people are saying that if there isn't some sort of military incursion here, it's just going to be kicking the can down the road because ultimately Iran's not going to get rid of their ballistic missiles. I mean, at what point is that a real pressure point that challenges the thesis that calls for dragging this out and a lack of a conflict?
The argument makes perfect sense. But if you follow, open source intelligence accounts and the like, you can point to about 100 or 200 signals since mid-January that suggested an imminent attack, right? It's sort of, yes, we're pre-positioning 24 F-35s. And then the following week, it's 48. And then really, we needed 48 all along, so 24 should not have been the signal. The goalpost keeps moving on this. So it's not, I don't disagree with the logic. It's just finding where that limit is, we think is a little later. And this is very similar to what happened with Maduro. Back in September, I believe, of last year, we wrote that President Trump was likely to take out Maduro, but he would take a lot of time. He would not be rushed into it. And by November, December, people were saying it has to happen now because we've deployed all this firepower. The truth is the president can afford to run the tab. And even from an operational standpoint, he does have the several weeks that he wants.
Andrew, as you know, Tehran and the Iranian economy right now is really struggling. How well funded are Iranian proxies in the region right now? What are their capabilities to cause disruption if Iran needs them to?
So their funding went through a hard period following the major strikes, and I'm not just referring to the June war of last year, but Israel's overall operations across the region. But they have really recovered quite well. If you take Hezbollah, for example, the smuggling routes for bringing in cash had to be rejigged, but they have been rejigged. The issue, though, is to be very transparent. I don't think that the reaction function of these proxies is going to depend that much on funding. I think it's going to be much more of a political decision. And we have a slightly nuanced position at Signum, which is we think that Iran will retaliate extremely forcefully. So the president's sort of scenario of a limited strike, limited retaliation is off the table, but not necessarily, in fact, not with its proxies. I think the proxies will largely sit this one out for political self-preservation reasons.
Andrew, could you describe what forceful retaliation would look like then?
Yeah, it's very simple. It's trying to kill Americans and Israelis, which is very different than what happened in June and during the prior operations, where the main goal was trying to demonstrate capability and sort of, show symbolic action. Here, we think that they will try to kill as many as possible. And from the military experts we speak with, it is statistically extremely improbable that we will have a war with Iran and no U.S. casualties.
Andrew, this is a serious conversation, and I think it's a question we need to ask. When you say kill Israelis and Americans, are you talking about in the region, around Iran, or beyond?
Both. I think they'll have less success beyond, just because their capabilities are less good beyond. I'm well aware that, Hezbollah and other groups have had success as far out as Latin America and the like. So that's not inconceivable. But I do think that there's a case to be made that short-range ballistic missiles have a better chance of killing American troops, for example, than Iranian operatives have at conducting a successful terrorist operation in the U.S., which has been largely off the table for the past 25 years.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.